Simmons First National Corporation just beat consensus expectations for their second quarter of 2026.
They did.
Yeah, they reported revenue of $248.6 million, and adjusted earnings per share came in at 50 cents, with reported EPS at 46 cents.
Right. And looking ahead, the guidance paints a really specific picture. I mean, management stated they're on track to deliver double-digit adjusted PPNR growth for the full year.
Which is huge.
Yeah, all while maintaining their full-year net charge-off guidance of, approximately 25 basis points.
And just on how the stock reaction is being supported internally, the company repurchased 700,000 shares during the quarter. That was at an average price of $21.52.
So they still have, like $161 million remaining in that 2026 authorization program?
Roughly, yeah. Approximately $161 million left. But, for you, the retail investor tuning into this deep dive, the mission today is to really look under the hood.
Exactly, because when analyzing a regional bank's earnings right now, a clean headline like that, it usually masks a tremendous amount of internal maneuvering.
Oh, absolutely. So we are going to examine the segment performance, the stability of their margins, the actual impact of management's strategic cuts, and, of course, the underlying credit risks.
Because to post those specific numbers in this current macroeconomic environment, it requires a management team to make some very deliberate, sometimes pretty painful strategic trade-offs.
Right. And you mentioned that adjusted PPNR growth, a 40% year-over-year jump in that core operational profit. It's a puzzle to solve.
It really is. PPNR, pre-provision net revenue, that's the purest measure of a bank's core operating engine, right? Before you even factor in the money they set aside for bad loans.
So we're looking at a financial institution achieving this massive growth while actively shrinking its physical footprint and cutting jobs.
Yeah, and the foundation of solving that puzzle, it starts with the net interest margin, or NI, the fundamental spread between what the bank earns on assets like loans and what it pays out on liabilities.
Customer deposits.
Exactly. And in the second quarter, Simmons held their NI perfectly stable at 3.84% compared to the prior quarter.
Wait, we should pause on that 3.84% figure. Perfectly flat.
Perfectly stable, yeah.
Because in the broader context of the banking sector right now, depositors are highly educated. They are constantly moving cash around to chase higher yields, in money market funds or treasuries.
Oh, yeah. They're hunting for every basis point.
Right. So keeping that spread flat on a linked quarter basis, meaning quarter over quarter, that's a significant operational hurdle.
It's a massive hurdle. And the mechanism behind how they achieved it is actually the most revealing part of the report. Their cost of deposits actually declined by 3 basis points.
Wow.
Yeah, bringing it down to 1.93%, which, when a bank is managing nearly $20 billion in total deposits, $19.7 billion to be exact, every fraction of a percentage point alters the bottom line by millions.
Millions of dollars, yeah. So managing to drive deposit costs downward right now, it implies they've fundamentally restructured who they're taking money from.
And on what terms? Absolutely.
And that restructuring, it ties directly into the commentary from their CEO, Jay Brogdon. He pointed to this, he called it a continuous improvement mindset.
Which I know it sounds like standard corporate jargon.
Total earnings call bingo phrase, right? But he actually anchored that phrase to specific efficiency initiatives.
He did.
He noted they're actively eliminating certain internal positions and systematically reducing their real estate square footage, and that these cuts are more than funding their investments in new business growth.
Right, and the immediate ripple effect of those cuts, it hits the adjusted efficiency ratio. That metric dropped 190 basis points, down to 54.26%.
Which is great for them.
Yeah, for investors evaluating bank stocks, the efficiency ratio is just a simple measure of how much it costs the bank to generate $1 of revenue. Lower is always better.
So pushing it down into the mid-50s, that indicates highly disciplined expense control.
Exactly. They are wringing more revenue out of a smaller operational footprint.
I want to visualize this cost-cutting strategy for a second because I think the distinction matters. It appears management is approaching this like pruning a tree.
Okay, I like
Right, like they aren't taking a chainsaw to the trunk and destroying the core business just to show some temporary savings on the income statement.
No, not at all.
They are selectively trimming the physical real estate branches and the associated headcount so the core root system can direct its energy into bearing more fruit.
Which in this case means funding their digital platform and, organic loan growth.
Exactly.
And that visual maps perfectly to the financial reality. The capital freed up by shrinking that physical footprint It's actively being redeployed into higher margin areas.
Where do we see that in the numbers?
You see the evidence in their non-interest income. It increased 8% on a linked quarter basis to $47.9 million.
Wait, I have to challenge the strategy, though.
Okay, go for it.
Simmons is a 123-year-old institution. They operate 220 financial centers across 6 states in the Mid-South. You cannot simply close community branches and expect a legacy bank to keep growing locally. Aren't they sacrificing their long-term community presence, that relationship banking, just for a short-term accounting boost to pad the margins?
Well, that's the traditional fear, right? But we have to look at the mechanisms driving that 8% jump in non-interest income. Because the revenue didn't come from a one-time fire sale of real estate assets.
It didn't.
No, it was driven by recurring operations. Specifically, swap fee income and positive valuation adjustments on their small business investment company, their SBIC investments.
Okay, let's break those down. How exactly does a regional bank generate swap fee income from its clients?
So imagine a mid-sized commercial client wants to borrow money to build a new manufacturing facility.
Okay.
They need the loan, but they are terrified of interest rates fluctuating over the next 5 years. They want a fixed rate.
Sure, for predictability.
Right. But the bank, Simmons, might prefer to issue a floating rate loan to protect its own balance sheet.
So they're at an impasse.
Exactly. So the bank facilitates an interest rate swap. They act as the intermediary. It allows the client to effectively lock in a fixed rate while the bank gets its floating rate exposure.
Oh, I see.
And for structuring and facilitating that complex transaction, Simmons collects a swap fee. It's a highly specialized, sophisticated commercial banking service.
And the SBIC investments?
Right, so small business investment companies, they're private funds licensed by the SBA, the Small Business Administration.
All right.
Banks invest capital into these funds, which then provide equity or debt financing to local small businesses. When those underlying businesses grow, the value of the bank's investment increases.
Which results in positive valuation adjustments on the income statement.
Exactly. So, to address your challenge about the community presence, they're replacing the passive presence of a brick-and-mortar branch with the active presence of providing sophisticated interest rate management and direct equity capital to local businesses.
So by structurally lowering the cost of the physical buildings, they permanently elevate the impact of that fee income.
That's the strategy, yeah.
But if they're successfully pruning the physical branches to fund these higher-level commercial services, the question shifts to whether that strategy is actually materializing on the balance sheet.
Right.
Because a continuous improvement mindset, it only matters to you as an investor if the loan book is actually growing.
Well, the loan book is showing very deliberate movement.
Yeah.
Total loans increased 3% annualized, bringing the portfolio to $18.1 billion.
Okay, steady growth.
Yeah, but the metric that institutional investors watch really closely is the unfunded loan commitments. Those jumped 8% to $4.4 billion.
And unfunded commitments, just to clarify, those are the lines of credit or specific loans that the bank's underwriting committee has fully approved, but the commercial client simply hasn't drawn down the cash yet.
Correct.
It's essentially the shadow pipeline of future revenue.
And within that shadow pipeline, their commercial loan segment is sitting at a really healthy $1.4 billion.
Wow.
Yeah, and even more granularly, management noted they have $374 million in ready-to-close commercial loans sitting there with a weighted average rate of 6.73%.
Oh, that provides a very clear line of sight.
Very clear. They have a runway of high-yielding assets queued up and waiting to be onboarded.
But this is where the mechanics of banking get complicated. To fund $1.4 billion in future commercial loans, a bank needs deposits. You can't lend out thin air.
No, you can't.
And we established earlier that they managed to lower their overall cost of deposits to 1.93%. So how is a bank gathering enough cash to fund massive commercial growth without paying top-of-market interest rates to attract depositors?
The secret sauce there is non-interest-bearing deposits.
Okay.
These are standard commercial and retail checking accounts where the bank pays absolutely 0% interest.
Zero.
Zero. And in the second quarter, Simmons achieved a 6% annualized linked quarter increase in these non-interest-bearing deposits. They now make up 22% of the bank's total deposits.
That requires some explanation.
It does.
Because in an economy where anyone can just open an app on their phone and get 5% on a high-yield savings account, how is a regional bank convincing people or businesses to leave hundreds of millions of dollars in accounts paying zero interest?
It all comes down to treasury management services.
Okay, how so?
Well, when Simmons originates One of those commercial loans we just talked about, say a $10 million line of credit for logistics company, they don't just hand over the money.
Right.
The loan agreement typically requires that logistics company to move its primary operating accounts to Simmons. So their payroll processing, vendor payables, daily cash receipts, all of that flows through non-interest-bearing checking accounts at the bank.
Oh, wow. It's the lifeblood of commercial banking.
Exactly. You win the loan, but the real prize is capturing the zero-cost operating deposits that come with it.
That completely explains the current quarter's growth. But, to fully grasp this deposit strategy, I think we have to look backward.
Yeah, to 2025.
Right. Management's current success is entirely rooted in a very painful decision they made in the third quarter of 2025. They executed a major balance sheet repositioning at that time, deliberately shedding higher rate, non-relationship wholesale deposits.
And we should define what they shed, because wholesale deposits, they're essentially institutional hot money.
Hot money.
Yeah, it's cash from brokers or large financial entities that only park their money at a bank for the absolute highest yield. They have zero loyalty to the institution.
They don't use the treasury management software.
Exactly, and they don't borrow money. If a competitor offers 1 basis point more in yield, that wholesale money vanishes overnight.
So management basically took a calculated hit to the chin in late 2025 by letting those expensive wholesale deposits just walk out the door.
Yeah, they let them go.
Which made their total deposit numbers look weaker at the time, but it fundamentally re-engineered their cost structure.
It was a textbook example of long-term strategic foresight. They shrank the balance sheet intentionally. And what you're seeing in Q2 2026, the stable 3.84% IM, the dropping deposit costs, the ability to fund that $1.4 billion commercial pipeline, it's the direct operational payoff.
They traded expensive, flighty cash for a cheaper, deeply entrenched deposit base.
Tied directly to local commercial borrowers. And that foundation is what allows their lending to expand profitably today.
Which brings us to the most critical part of this analysis.
Credit risk.
Credit risk. You do not fund $1.4 billion in commercial loans in this macro environment without taking on credit risk, especially for a regional bank with heavy exposure across the Mid-South.
Right.
So if they're aggressively lending to businesses, we need to examine the risk of those loans going bad.
Absolutely, because credit quality is the ultimate arbiter of a bank's survival. Looking at the realized losses for the quarter, the net charge-off ratio, the NCO, it sits at 20 basis points.
Which is a highly manageable figure. It comes in comfortably below management's full-year guidance of approximately 25 basis points.
Right, but the actual losses don't tell the whole story, do they?
No, they don't. We have to look at the provision expense, the money the bank takes out of its earnings and literally locks away in a vault to cover future anticipated losses.
And Simmons set aside $17.4 million in provision for credit losses during the second quarter. That provision expense, it exceeded their actual net charge-offs by $8.3 million.
So they're over-provisioning.
Yes, by aggressively provisioning more than they actually lost. They pushed their allowance for credit losses, the ACL ratio, up to 1.32% of total loans. They are methodically building a fortress balance sheet.
Preparing for potential economic turbulence. But, a management team doesn't build a fortress unless they see an army approaching.
Very true.
And looking at the detailed loan metrics, there is a very clear reason they are hoarding reserves. Total non-performing loans, NPLs, increased to $166.1 million.
Yeah, that's a jump.
And in banking, a non-performing loan is one where the borrower has stopped making payments for an extended period, usually over 90 days. A spike in NPLs is an immediate red flag for investors.
It is a red flag, but context determines the severity of the threat, right? The critical detail here is the exact driver of that increase. Management provided extensive transparency on this. The entire spike in non-performing loans was driven by the full migration of a single 1-to-4 family real estate construction relationship.
Wait, a single relationship?
Just one.
So this isn't a systemic, widespread collapse across their commercial real estate portfolio. It's one specific, highly concentrated, bad deal.
Exactly.
And importantly, this wasn't a surprise to the market. Didn't they explicitly warn investors about this specific relationship back in the first quarter of 2026?
They did. They disclosed the weakness in 1Q26. Yep. The loan simply followed the standard, predictable credit migration path. It went from the watch list to criticized to classified and finally transitioned into fully non-performing status this quarter.
So the market hates surprises, but this was highly telegraphed.
Very telegraphed.
It's kind of like, think of that single real estate construction loan like a known pothole on your daily commute, right? You knew it was there because you saw it forming yesterday. So when you finally hit it today, it feels rough. Your NPL numbers spike on the spreadsheet. But because management knew the pothole was unavoidable, they had already packed a spare tire.
And in this scenario, the spare tire is the $13.5 million in specific dedicated reserves they've already allocated explicitly to cover potential losses from their top 10 non-performing loans.
Right, so the damage is isolated, and the financial shock absorber is already fully funded.
Exactly. But the question investors really need to ask is whether hitting this one massive pothole means the rest of the road is falling apart.
Yeah. Does this one bad construction loan suggest we should ignore the broader credit metrics?
Well, that's the pushback we need to apply. If they miss the underwriting on a major construction loan, what else is hiding in the portfolio? Are the broader forward-looking credit trends actually positive, or are more potholes forming?
Right.
But the forward-looking indicators are decidedly positive, and they provide a really strong counter-narrative to that single NPL spike. The silver lining is found in the early warning metrics.
Let's look at those.
So criticized loans. These are loans that are currently paying on time, but the borrower's financials are showing some early signs of weakness. Criticized loans actually dropped to their lowest level in the last 10 quarters.
Wow.
Yeah, they now represent less than 3% of total loans.
And classified loans.
So classified loans are a step worse than criticized loans. The weakness is severe enough that the bank might take a loss if things don't turn around, but they're not yet non-performing.
Right.
Classified loans dropped to just 2%. So while that one specific real estate deal caused a localized spike in the non-performing category, the total volume of new loans migrating toward the danger zone is actually shrinking significantly.
The pipeline of future problems is drying up.
That's drying up.
And that early warning data changes the entire complexion of the earnings report. It explains the management team's confidence. They have a firm grasp on the localized credit risk. Their margins are remarkably stable because they absorbed the pain of restructuring their deposit base last year, and they are ruthlessly pruning their operational expenses to fund the next wave of commercial loan growth.
And furthermore, they're executing this entire strategy while maintaining robust capital buffers.
Which is key.
Right. Their Common Equity Tier 1 ratio, the CET1, ticked up slightly to 11.60%, and their Tangible Common Equity ratio sits at 8.91%. I mean, they are heavily capitalized by any regulatory standard.
And that excess capital is what gives them the flexibility to buy back 700,000 shares of stock, continue paying out dividends, and absorb an isolated real estate loss without altering their strategic trajectory.
Exactly.
So what does this all mean for you, the investor? Let's bring this deep dive home and synthesize the mechanics we've uncovered. Simmons First National Corporation delivered a quarter that really rewards those who look past the headline numbers.
It definitely does.
It was defined by stable margins secured through proactive balance sheet management, disciplined expense control that is actively financing future technological and commercial growth, and credit risks that are isolated and heavily provisioned for.
It really serves as a masterclass in a bank manufacturing its own operational leverage. I mean, they aren't sitting back and hoping for the Federal Reserve to cut interest rates to save their margins.
Right.
They're actively dictating their own efficiency and managing their own cost of funds.
And for the retail investor holding the stock, the historical context is paramount. Simmons carries a legacy of 117 consecutive years of paying dividends.
That's incredible.
With a current yield sitting around 3.8%, that century-long track record remains fundamentally supported by the underlying operational metrics, the strategic pruning, and the fortress balance sheet we dissected today.
It is, and that historical track record is undeniable.
Oh.
But, the data from this quarter also presents a provocative thought for you to explore further.
Oh, what's that?
We just analyzed a management team that is aggressively shrinking its physical real estate footprint and optimizing headcount, while simultaneously pouring capital into sophisticated commercial services, treasury management, and digital growth engines.
Right.
Are we looking at the blueprint for the mid-cap regional bank of the future? One that relies far less on the 123-year-old physical branch strategy and entirely on an agile, high-efficiency, digitally enabled platform?
It is the ultimate question for the sector. I mean, if pruning the tree is the only way to ensure it keeps bearing fruit in a modern economy, how many physical branches does a legacy bank actually need to keep its roots healthy?
Exactly.
That is a fundamental tension to carry with you as you monitor the evolution of regional banking. Make sure you follow the show right now for daily, in-depth earnings coverage so you never miss the mechanics behind the metrics.